Hi there, eToro. It is Monday the 19th of June, and that means it's time to take a look at what moved the markets last week. Each week it feels as though I'm spending more and more time on this part of my messaging, but things are getting a little out of hand. For example, on screen right now, the candles, those are the NASDAQ 100, so the 100 largest companies from the NASDAQ composite, and you can see that the year-to-date return last week touched over 38% and closed on Friday just above 36% for the year to date, which is from the beginning of the year to that point in time. The NASDAQ composite, which is the orange line, has also done fairly well, over 31% return year to date. And S&P 500 is trailing those by quite a lot, but still done quite well given the economic conditions that the world is facing right now and the high interest rates, returning 15%, over 15% year to date. Now, one thing that I can say with quite a lot of conviction is that towards the end of last year, tech stocks, a lot of tech stocks, were heavily oversold through November and December. However, the size and duration of the rally that we're seeing, particularly amongst big tech companies right now, is not justifiable when you look at what is going on in the world right now. Those things being, there are high interest rates just about everywhere, particularly in leading economies. Inflation, whilst the back of that beast has been broken, inflation is still quite high. Economic growth is slowing down quite a lot, not as much as some had expected, but it is definitely slowing down. And earnings for these companies are either growing very slowly or shrinking and are forecast to not grow very much or even shrink over the next year or so. On top of this, we're also starting to see signs of that euphoria that we see in the markets as it approaches its high just before it ultimately gives something back. For example, AI is now being pushed as the thing that is going to drive the markets higher even from this point for the next few months to years. Now, as a person that's been involved in technology for many decades, I agree. AI is going to change the world. It's already changing the world. It's going to change the world in unforeseeable ways through the next decade or two. But that does not change the fact that economic conditions that businesses are operating within right now are incredibly challenging and are going to remain that way for some time to come. What messages like this are trying to say is that this time is different because of X, but it's not. Economies and the markets will continue to play out as they always have, going up and down, and the higher they go, the further they fall, and the further they fall, the higher they go once that bear market is over, of course. What this means personally for me is that I'm going to exercise a bit more caution within my portfolio. I've already closed quite a few positions within my portfolio, and I think that I've increased my cash position to something over 20% of the invested portfolio right now. In the long term, the market rises. The global economy continues to grow. However, the market has risen so quickly in such a short period of time against a backdrop of very weak economic conditions that I can't help but want to be a little bit cautious over the next few weeks and months. All right, with that out of the way, let's take a look at some of the macro that hit the markets last week. There were a lot of very interesting and important data points that hit the market last week. Some of the most important being the Federal Reserve's meeting where it announced that it would keep rates flat for now. However, they were fairly hawkish, saying that they expect potentially 2 more quarter-point increases through the rest of the year. What I found quite strange, and it's a sign of the times right now, I guess, is that the markets took this news quite negatively initially and then continued to rally. So the news about rates isn't good, but the Fed is doing a few things here. First of all, they might just be saying this and they don't actually carry it out, sometimes called jawboning, because they want to make sure that the market participants are kept in check and they want to do something about this runaway rally that they've been seeing in the market. We also got some very good news, some very positive news. So PPI, the producer price inflation, this is a leading indicator on CPI. So the prices that people pay when they make things tend to influence the prices that they charge when they sell things to the consumer. What we can see here is that PPI prices, the last value that came in was negative and was quite a lot lower than expectations, which is fantastic. We also had quite a few different readings of inflation, but most of them were very, very good. So the inflation rate month on month, quite low, which is fantastic. The headline rate overall definitely heading downwards and quite sharply. However, core inflation, which excludes the prices of more volatile items such as food and energy is really sticking to its guns. We can see that this seems to be trending downwards, but not nearly as fast as the overall number. And if it doesn't fall, it means that inflation overall will remain elevated for quite some time until it comes down. I have on screen all of the macro data points that I watch for last week, and by and large, it was good news for the economy. For example, we can see that retail sales within the US remain quite high, and this is part of why the Fed will want to not take their foot off of the interest rate pedal just yet. We can also see that initial jobless claims is higher than expected, and this is a data point that is very important to the Fed. I mentioned those stickier parts of inflation, and one of the things that can cause inflation to remain sticky is a very strong labor market. If the market is good for employees, then they will be able to demand wage hikes. And anytime that a business has to hike its wages, it then tries to pass the cost of those wage hikes through to the consumer, which drives inflation higher. We also got the GDP number out of the UK, and it is in line with expectations. And now it is thought that the UK will not enter a recession, which is hilarious, given that I think it was 6 or 7 months ago, the Bank of England, central bank, said that there was going to be a deep, long recession within the UK, and everyone was nodding along, yes, we think this is going to happen. So not even the central banks can tell you what is going to happen within their economy. So don't trust anyone when they try to forecast this type of information. And we also got the CPI number out of the EU, which is higher than the number in the US, but is declining, going in the right direction, and is bang on with expectations. In terms of action within the portfolio, I've been closing out my positions in some equities in order to build my cash position. Last week, I took the decision to close out my position entirely in Palantir Technologies. I love the company. I think that they've got fantastic software products. I think that they are building out a great client roster. However, you can see that there's been this enormous run in the share price. And if you look at the various valuation metrics, they're looking pretty bad for Palantir at the moment. Now, that's not to say that the company could grow into this valuation at some point. But again, the market conditions, the speed with which the share price has risen recently, and the current trend in revenue and earnings, I don't think justifies this very high stock price. So I've closed out my positions, and if the share price drops, I will be back into Palantir. I wanted to demonstrate the companies that have been carrying the indexes, but unfortunately Stockopedia is down, and the best view that I have of that is unavailable because I can't log in right now. However, I think we know who those very big companies are, right? They're Apple, they're Microsoft, they're Amazon, they're Google, they're Facebook, and so on and so forth. And Microsoft has to be one of the best quality companies out there. It's a technology company, but it's highly diversified. It has fantastic products in a number of technology subsectors. It's made the right acquisitions. It's growing revenue strongly. It's growing earnings fantastically. They've just bought their way into the AI race and positioned themselves fantastically. However, their share price has grown nearly 40% over the past 12 months. If we look at the various growth metrics that underpin this business, so here are the numbers that show you revenue growth or growth and profitability, and those can be sliced and diced a number of different ways, growth and free cash flow. We can see that growth in the company has been okay. It's been pretty good given where the world economy is, but it's not that fantastic. It's not 40% in the past 12 months fantastic. And so we find that there is a mismatch between how far and fast the share price in Microsoft has risen and how far and fast revenue and profitability have grown. And that means that the valuation metrics for Microsoft don't look great. Now, I know the argument against this. The stock market is a place that's trying to forecast where companies will be at some point in the future, anywhere from a few months to a few years out, depending on how optimistic the market is at that point in time. But I think if you stop and ask yourself, where do you think the world economy will be 1 year from now? I think in a best case scenario, it might be slightly higher. Where will interest rates be 1 year from now? Probably still quite high. Where will inflation be 1 year from now? Probably above the target of 2 to 2.5% that most Western countries have been setting. The combination of those factors makes it very difficult for companies to grow. And if companies aren't growing, then can they really justify share prices that have risen 40% over the past 12 months? I don't think so. Now, that's not to say that there aren't a number of companies out there whose share prices are still quite low and the value of those businesses is very attractive. It seems that there's been a rush to safety in the big tech companies, and that's been driving the prices up. And I think now a lot of the bears have capitulated, and now they're trying to get in on this bull rally, which is usually a sign that we're fairly close to the end. Now, what about this week? Well, last week was a very busy week when it came to macro data, particularly the countries that I like to watch. And this week should also be fairly interesting, but there's not as much going on. We can see immediately that the US is on holiday today. China begins a 2-day holiday towards the end of the week. But we do see that we're getting inflation data year on year out of the UK, which I'll be very interested in. The BOE will also be providing us with their interest rate decision, and I think that they're going to hike rates at least 2 more times, which is not great if you have a mortgage on a variable rate. I'm sorry. We'll also get a more recent reading of initial jobless claims out of the US, which the Fed watches quite closely, and we'll get PMIs out of a number of different economies on Friday. One thing that I am watching quite closely is political ties between the US and China have not been great. They've been deteriorating for quite some time now. And it seems as though both countries are trying to work at that relationship, although things keep on getting in the way. The Chinese economic recovery has spluttered a little bit recently, although I expect eventually it will take off. However, investors aren't yet pouring into Chinese assets until they see a bit more positivity in the relationship between these two countries. So this is something that I am watching very closely. All right, that's it for this week. I hope that you're having a sunny, hot summer wherever you live, and I will speak to you soon. Goodbye.